Welcome to the Global View. Let's find a way to make money outside the ASX-listed universe. Just a quick one on the data overnight, though. We had interest rate cut expectations in the U.S. stoked by the data. U.S. ADP jobs report adding 103,000 jobs last month, so that was below estimates. And the data for October was revised lower. Also, worker productivity grew faster than initially thought in the third quarter, putting more downward pressure on labor costs. This, of course, comes ahead of the non-farm payroll report due Friday. So we've now got expectations for a rate cut of at least 25 basis points in March at 60%, according to the Fed Watch tool from the CME, up slightly from about 50% a week ago. Also, we had the Bank of Canada leaving rates at 5%, but saying they could hike again. Still concerned about inflation, acknowledging, though, an economic slowdown and general easing of prices. We did see pressure coming through on the U.S. 10-year Treasury yield. We saw strength in the U.S. dollar. Actually, earlier, the dollar index hitting a 2-week high. So that is a pretty good starting point for our conversation with Tim Murray from T Rowe Price, who joins me now. Tim, welcome. An absolute pleasure to have you here this morning. When you hear that data from overnight, when you hear the expectations for a Fed rate cut coming next year, what do you think?
I would say it's a little bit optimistic to say 60% chance in March. I think what's going on there is if you really look at the data, part of that is that there's a chance we get big cuts. There's a chance that given the weakness, that we have seen recently in the labor market in the U.S., that we could be somewhat close to a possible recessionary scenario early next year. So I think that's what is being priced in there. More likely, we get no cuts, but the chance that maybe we get maybe 3 or 4 early next year is what the market's catching there.
Okay, so look, you and I, Tim, are not going to solve this interest rate question right now because there really is, the jury still being out. But when we think about this rally that we've seen toward the end of the year, when we think of the overall narrative this year, a lot of it has been driven by the Magnificent Seven. But in your view, has all the good news been priced in?
Yeah, what I would say is that certainly, if you look at U.S. stocks, the S&P 500 PE is at 18.7. That really on the surface looks expensive, especially when you recognize that the long-term average of the S&P 500 index forward PE is 16.5. So, boy, U.S. stocks look really expensive. But if you take out the Magnificent Seven, I think that's really important here. You take that out, it's actually 16.5. The rest of the S&P 500 is at 16.5 right now. So what you're seeing there is what's expensive, not U.S. stocks broadly. What's expensive is the Magnificent Seven. And I think when you look at that, you say, boy, maybe it's just the Magnificent Seven that's too expensive. I'd make some key points, though, about that. Magnificent Seven at 28.4 is what the market cap weighted PE is there. That sounds like a lot, a premium of 12. But if you dig in, if you look at the fundamentals, and I think, personally, I think one of the best metrics out there to just capture fundamentals is return on equity. And I can tell you that for the S&P 500, if you take out the Magnificent Seven, the return on equity is 16.8%. For the Magnificent Seven, return on equity is 33.6%. It's more than twice that of the rest of the S&P 500. So that 28.4 that you're getting from the Mag 7 as far as PE, it looks really expensive. But if you really dig into the fundamentals, not that it certainly looks justified, certainly looks unreasonable. I think there's certainly reason to debate whether that premium should be 12, maybe it should be 10, maybe it should be 14, but certainly I wouldn't say that premium should disappear anytime soon. So I would say, U.S. stocks aren't as expensive as they look on the surface.
When we get to the Magnificent Seven in particular, though, okay, so they're not that expensive. But what is the question for 2024? Can the level of profitability be sustained? Like, what do we need to happen for those 7 companies to not prove a counterweight to those other U.S. Equities that you say are not overvalued?
Yeah, so I would say certainly their expectations are pretty high. There's not a lot of room for upside from those companies because unlike at the start of 2023 when the expectations were actually low, a lot of people were worried about these companies. For 2024, you've got artificial intelligence, which is really the big tailwind at this point for these stocks. But also, you just got the fact that they have such huge margins; they can fund any growth initiative organically through cash. They don't have to worry about rates going up because any debt that they have that's coming due, they have the piles of cash to just turn around and pay those off. So I think the big driver is going to be what happens with artificial intelligence. Does the spend, does the impact to earnings that we expect to see from artificial intelligence start to manifest itself? If it doesn't, there's certainly room for disappointment there. If it does, then I would expect these companies to hold up very, very well.
Okay, so Tim, just sort of wrapping it in a bow for us then. We do have another quarterly earnings season coming through mid-Jan in the United States. What do we need to be hearing from not just the Magnificent Seven, but from other, U.S. market leaders, so to speak, when it comes to giving us some sort of sense as to where that return on equity and in relation to valuations will sit going forward?
Yeah, I think one of the things that you really have to take a look at, and it's not so much going to come from these large public companies. It's really in the small business arena because that's where the labor market is. About 2/3 of U.S. employment comes from companies who have 500 employees or less. So the question is going to be, and right now we are seeing some weakness in the labor market. Now there's a big buffer there. We have job openings has come down quite a bit, but you've still got more than 8 million out there. There's still a buffer if you look at how many people are looking for a job versus how many job openings there are out there. There's still an excess demand for labor of 3.5 million. But it's really heavily concentrated among the services sector, which is heavily concentrated among small businesses. So that's what I would look at. Are small businesses suddenly laying off employees? That's really where the question mark is, because what we know about unemployment is that once it starts rising a little, it usually rises very quickly. It rises a lot. So that is what I would be paying attention to. Not so much what the S&P 500, what the large corporations are saying, but what the signals are that we're getting from small businesses and what we're seeing from the labor market.
Yeah, well, we've got some data coming late this week, don't we, Tim, that we'll be keeping a very close eye on. Do you agree that it's not so much the number that comes out on Friday that you want to pay attention to, but the potential revisions that come through?
I wouldn't say so much that it's the revisions. I think you definitely have to look at it. What you have to do is not look at one number. You have to kind of look at the average, the rolling average, and how that's going. Don't pay too much attention to one number. Kind of pay attention to what the run rate is. So each incremental data point, you can't put that much weight on just one incremental data point. The revisions will help you kind of look at, okay, what's that rolling average looking like? So that would be the point that I would make is really important. One data point is not the entire picture. One data point is just an incremental addition to the picture.
Tim, it's been a pleasure to speak with you. I really appreciate your time today. I know that it's getting late there for you.
Thank you. Thanks for having me.
Tim Murray there joining us from T Rowe Price, and he was in the States. So let's take a look at what we're expecting here locally. A bit of a dip upon the open, down 34 points. Energy will be in focus. Tech will be in focus. Did see Wall Street ending lower through the overnight period. No major, well, we do have trade balance coming out here locally. Also, we'll be keeping an eye on the same in China. The retail entitlement offer for Helios closes, and we're keenly waiting to see what happens to Perpetual and Washington H. Soul Patch shares upon the open. That is the global view for today. Stick around. We'll get you across all the market moves next.